I'm going live.
All right, guys. We're live. Let us know if you can hear us. Welcome to this very special show on something that everybody loves. Taxes, right? Crypto taxes, okay? So we have here, today we have Crypto Herc and myself.
Hey there, guys. How are you? All good.
All right, so we're going to be discussing how you can make crypto taxes a little bit less painful, but more easier to do. We'll be joined by some very special guests, and we'll have some special offers, and we'll also have a special giveaway that we'll be sharing later. So stay tuned. But first, a few words from our sponsors.
PrimeXBT is the most powerful trading platform offering immediate access to over 30 assets. Trade cryptocurrencies, forex, commodities, stock indices, and much more, all from a single Bitcoin settled account. Visit the link below and start trading on PrimeXBT in minutes.
Ferrum Network is an interoperable DeFi ecosystem offering token pre-sales, staking as a service, project incubation, and much more. Visit thebirbnest.com/Ferrum. Globe is an upcoming crypto derivatives exchange offering up to 100 times leverage on crypto and DeFi perpetual contracts. Sign up for early rewards at thebirbnest.com/Globe. Radix is the first Layer 1 protocol built specifically to serve DeFi. More information at thebirbnest.com/Radix. YFDAI is democratizing finance by creating the most secure, transparent, and user-friendly ecosystem of DeFi products. To learn more, visit thebirbnest.com/YFDAI.
Okay, cool. So we are back after our sponsors. So now it's time for our special guests. So I would like to invite Alex from accounting and Joe from mine accounts. Give me a sec. Yep. Hi guys, how are you?
Hey guys, good. Thanks a lot for the invite here.
Good, thank you. Good to be
No
here.
worries. Thank you very much for your time. Would you like to have a round table, like to introduce yourselves and what your position is?
Sure, yeah. So I'm Alex, one of the co-founders of Accointing.com. Essentially, Accointing.com is a tracking and tax tool. You integrate your exchanges and wallets, and then we pull all of the transactions in order to properly display it so that you know what your portfolio is like, and also to then at the end create a tax report.
Hi, I'm Joe David. I'm the founder of Miner Accountants. We are a crypto and blockchain specialist accounting firm based in the southwestern UK. My background is accounting. I've got a practice by the name of Nephos on the t-shirt, and we're a fully cloud digital-based practice. Working for kind of typical UK SMEs, and in the last 6 months we've really honed down on our work with the crypto space, and yeah, really delighted to be here today to talk to everyone.
Good stuff. Thank you. So I will start by the two certainties that life has, right? Death and taxes. And with that in mind, now in the last few years, we have seen people getting richer and richer through crypto, which is amazing. That's all that we want, right? But it gets quite complex when it comes to filing the taxes. And I'm based in the UK as well. And today we are going to focus in the UK taxes, how to file tax in the UK. And the organization that files the taxes, that checks everything, is HMRC. Now, the problem is that it gets very complex because in crypto, the one thing is that in crypto, you may have multiple income streams. So it could be farming, it could be staking, could be, trading, or ICOs or anything else. And the second bit, and correct me if I'm wrong, Joe, is that governments, especially the UK government, they are a bit behind when it comes to tax, right? They are not very specific. Actually, they are a bit specific, but at the same time, they are a bit vague. So you are kind of as a as an investor, you're kind of trapped, and you need to go to HMRC online and read like a manual of 100 pages. So it's very difficult actually to find your way out of that. So I would love to hear, I don't know how you want to kick this off. Would you like Joe to provide some information regarding what are the complexities when it comes to taxes? And then we can go through the accounting, how the app actually empowers users and simplify their filing their taxes. What do you think?
Yeah, absolutely. I think that makes the most sense. Just I guess also, so Mina and Accounting has decided to do a partnership for UK specific taxes. And so we work very closely. And so, yeah, I think it makes most sense if Joe kind of starts discussing about what actually needs to be provided and what needs to be done in terms of UK taxes.
Yeah, cool. Yeah, fine by me. I'd like just to go through a brief kind of slideshow if that's possible. Perfect. Cool. So thanks guys. So like I said, my name's Joe. Myself, a crypto enthusiast and an investor, and I just think the space is fantastic, and I'm really excited about the future of it. And when I did a lot of research on the space, I found there's not many people that really are accounting-wise that are that invested in the space that they really want to understand every part of it. And some people might be able to give you some advice on capital gains tax here and there and things like that. But when it comes into the more complex, kind of DeFi space and things like that, there really aren't many people out there. So I felt it was a really great opportunity to actually work in an industry sector that I actually loved myself, and makes it much easier to work in it when you love it yourself. So just really quickly, like, who are we? So as I said briefly before, we are one of the first dedicated crypto accounting and advisory businesses. There's a few that are out there, but we are one of those few. And we feel that we've got expertise in not just the cryptocurrency, but also DeFi and blockchain products and investments. Our brand, as I mentioned, Nefos, a forward-thinking digital accounting practice. And what that means is, whilst Mina has only just come to fruition in the last kind of 3 to 4 months, the Nefos business has been going for 8 or so years. So we've got quite a lot of skills and experience behind us and team to support you. And we've worked with many different people, individual investors, but all the way up to exchange platforms. We've got one of the DeFi platforms, one called Diversify. They've been our client with Nefos for over 2 years now. So very, very well tuned into the space. So if the screen doesn't quite fit on the screen, does it? I'll talk it through anyway, and can always share this if people need it. So I'll try not to go too complex in too much detail, because I appreciate it may not be the most interesting subject for me to talk in too much detail. So I'll summarize it. It's not missing much on the end, so it's not the end of the world. So ultimately, cryptocurrency is seen as by HMRC here, is seen as a digital asset and therefore taxed under Cgt Rules, which is capital gains tax. So it isn't seen as a currency. It is seen as an asset. HMRC have recently updated, when I say recently, at the end of March, updated their guidance, which has made it a lot better to understand and a lot easier to understand, but there's still a huge amount of gaps in that guidance, which I'll hopefully come on to in a bit. One of the most simple things that a lot of people miss is that crypto to crypto is a taxable event. So it doesn't mean I've had a lot of people phone me and say, I haven't taken any money out yet, therefore I don't have a taxable event. And that couldn't be further from the truth. Every single trade that you make is the disposal of one asset and a purchase of another asset. So that's really, really important. And we'll come on to how Accounting help us ensure that we get the right data later. But one other point on that is that the second point here on this slide is that actually if you use crypto to buy services and pay for things, that is also a disposal. And again, people kind of forget that because they're not used to spending money and it becoming a taxable event. But in this case, it would be, because you're disposing of an asset. And one thing we pointed out here is that the difference between the share rules in the UK and the crypto rules are that people get confused by the crypto to crypto, and that's mainly because with shares, you can't trade share for share in the main. So you can't trade an Apple share directly for a Google share. You'd need to trade that Apple share back into your local currency, whatever that is, GBP, etc., and then use that GBP in order to buy the other share. And that's why I think a lot of people get confused around the crypto to crypto thing, because they're so used to having to go to fiat first that they forget that in crypto we can go directly between the two assets.
Yeah.
So just like to point that out. In a simplistic sense, the gain or loss is calculated. We take the sale price of the asset, less any cost of disposal, so network or exchange fees, and then minus the initial cost of the asset, and that will give you the figure that is, in the simplistic terms, that is the gain on that particular asset. The CGT rules are also very similar for crypto as they are for shares. So some people probably won't be familiar with some of these things, but there are things called the same day rule, 30-day rule in terms of how they get pulled together. So if you buy shares within a certain time period, buy crypto within a certain time period, the list price of those cryptos can be pulled together in the same rule. And there's also something called bed and breakfasting, which basically is where you sell and buy in a very short period of time in order to benefit from a favorable tax position or something like that, and you can't do that either. I won't go into dramatic amount of detail on that because it is quite complex, but I'm more than happy to take questions. I'm not sure if we're able to on here, but more than happy to take questions after on various platforms if needed. And the current allowance, which is quite important for capital gains, is tax-free, is £12,300 per person per year. So the other question we get asked a lot is, am I taxed under capital gains tax or am I taxed under business income? And there is a big difference, because there's a big difference in the rates of tax that are applied to those, but also there's a big difference in the offsets that you can make in order to reduce your taxable allowance. So HMRC here have basically said that they don't feel that very many people at all will be classified as traders. They are expecting that it will be a very minimal amount of people, because they've set a very, very high bar on the threshold. I put in the example of 5,000 trades. This presentation I did recently was for another firm of accountants, and they weren't quite as au fait with the kind of the crypto transactional base. And what I was trying to highlight was it would be very, very easy for a simple individual with not a great amount of trading to hit 5,000 trades in a year, because of the nature of how one trade could end up being 50 trades off the back of it. So I was trying to highlight that even if you looked at someone with 5,000 trades, that's not very many. So it really does need to be a really high bar in order for HMRC. But what they're also looking at is sophistication. So do you know what you're doing, or are you just speculatively going on Twitter and taking the latest one from there? Or are you kind of spending day and night researching and really understanding everything, and so there's quite a lot into whether you're class. So 99% of people on this call will be taxed under.
And I have one question actually, and there is also one question from a follower. So my question is that also if you become a trader, if HMRC recognizes you as a trader, then you get taxed. You get the income tax, where the percentage of the tax could be higher, right? It depends if you have a day work, or even if you have sophisticated tools and you have like more than 5,000 trades and you become a trader, it doesn't mean that it's in your benefit, because I think, correct me if I'm wrong, if capital gains, if your capital gains are more than 12,300, it's just 20%.
Yeah, and that's the big thing here. The difference, though, is, and why people sometimes are keen to be traders, are because you can actually offset. So with a capital gains tax, there's very little you can offset against that. It's basically how much did the asset cost you, any kind of cost of disposal, and that's basically what your cost base will be. You take that from your sales price to give you a gain. So there's very little maneuver on the kind of like what the profit is, if you like, on that gain. The difference with business income or being taxed under income tax is you could then start to include a lot more things as deductible costs. Maybe computer purchases, or things like that. So actually, some people quite like being classed if they are, especially if they are doing quite a lot of work in the crypto space, and they do want to be a trader. Is they've got a lot of assets that they purchased that they'd like to offset against their income. So there can be pros and there can definitely be cons. But the rates are, as you say, are pretty much half. For CGT. So simple case, yes, you're much more likely to want to be on the CGT space.
And
there is a question. There is this question. Sorry, Alex.
In terms of trading, doing derivatives trading, right? There's a difference there as well, right?
Yeah, I do come on to a bit around kind of
cool.
stuff like that in a bit. So we'll touch on that in a bit if that's okay.
Cool.
A question that probably it's a yes or no for you, Joe. Do you have to declare capital gains if it's less than the allowance? I think no.
It's not a yes or no answer, actually, just to be annoying. Yeah. So I actually got asked this by someone on Twitter the other day. But so basically, in simple terms, no, you don't. But there are two occasions when you do, and they are when your gains. When the assets that you've sold, even if the gain is lower than the amount, if the asset is more than 4 times value of the allowance, then you do have to. And secondly, if you're already registered for self-assessment for whatever reason, you're self-employed or you've got property that you rent out or something, then you also have to do it in that case as well. So in most cases, no, you don't. But in a few certain circumstances, yes, you do. And again, I'm happy. I'm sure we'll give out social details and things like that later. So I'm more than happy to answer those questions.
Yeah. So for the details, you can first of all, you can subscribe to our YouTube channel, and you can see in the description of this video all the information to reach out to Joe's company and to accounting. We are going also. You will find a Gleam link. There is a giveaway. So the giveaway is 3 accounts, pro plan accounts by accounting. And the great news here is that accounting will soon become the Birb Nest partner. So that's exciting, and we will be able to provide you with special offers from the guys. There is one last question for you, Joe. So this is it question. So if you bought years ago at a low price, is it possible to buy some now at high price to bring your average buy price up in preparation for a future sale?
Yeah. So yes, you can, but ultimately it comes down to when I talked about the rules around the 30-day rule and things like that. So ultimately, anything bought within 30 days, you can pull together under pretty much an average cost basis. But 9 times out of 10, you're going to be looking at a FIFO, so first in, first out. So ultimately, you will buy, and that's how. Correct me if I'm wrong, Alex, but that's exactly how you guys calculated, isn't it?
Yep. Exactly.
So if you buy it 2 years ago at £1 and you sell it, today for £5, it doesn't matter what you've bought in between that. It will go back to the first purchase of £1. But if you do it within 30 days, you can pull those together a bit more. But years apart, you have to do a first in, first out sale process.
Got it. Thank you. Okay, please continue.
So some of this I may rush through. I have a question. In terms of UK regulations, right? Crypto is very young. How often do you see changes in these things? Like whatever, all these rules, laws you're talking about right now, do you expect them to be around for the next 5 years, or do you think it's going to change every year? I mean, I think it's going to change regularly. I think ultimately, I don't think HMRC fully understands space, and I don't think they, for one really, really quick example, there's no guidance at all around NFTs. So that's one thing, for example, that has obviously taken quite a lot of publicity recently, that they've got no guidance on at all. So I think it will be updated. I think the base of what they're saying will stay the same, because a lot of the asset-based rules for crypto are the same as asset-based rules for shares in the UK. So I don't see that changing dramatically. Maybe as cryptos become more currency-based, especially certain ones that are used to buy and sell goods and services, there's an argument to say, are they now currencies?
But in the main, I expect more clarification around those bits that we don't have, rather than direct change to guidance that's already there.
Right.
Does that make sense?
Yeah. So basically, you should stay tuned to these guys.
Pretty much.
You go with the specialists, yeah.
Yeah, but no, a simple thing. We're part of Crypto UK, trade body here in the UK, and we're sitting on HMRC roundtables and things like that to be able to be involved in these conversations. So, on a serious note, do keep an eye on what we're doing, because we are trying to be at the forefront of this market as we can. So just a few basic points here. I just wanted to quickly, again, like I say, some of this presentation was for not so crypto savvy. So if some of these are really obvious, then obviously we'll gloss over them. Lost keys or stolen funds. So this is a really weird one, because HMRC don't consider the lost keys or stolen funds as a disposal, which in one sense you would argue is a good thing, because therefore you don't realize any capital gain. But on the flip side, what they're basically saying is you still own those assets until ultimately they're claimed by someone else. But naturally, it's impossible. If a lost key is lost, it's impossible for it to be claimed in theory by somebody else. So it's a bit of a strange one. I'm not really sure HMRC have got their head around it, and I think they've just put a one-liner in there just to cover it. But I don't think they really understand what they mean when they're talking about that.
Wait, if you lose your keys and somebody sells your assets but you don't control it, do you have to pay taxes for those?
What they're saying is if you lose your key, and nobody's accessed your funds until they're still yours. Do you see what I mean? Like, until there's proof that they're not yours, they're yours. And ultimately, those keys and everything apply to you. So what they're saying, and this is why I'm saying I don't think they fully understand what they're talking about, because it's not like if someone steals my iPhone and takes my, it's a physical asset that is much clearer for someone to do. So I think this is something to watch, because at the moment, this is all they talk about, is that if it's lost, we don't class that as a disposal, and therefore they're still owned by the investor.
Well, so if the thief sells my crypto, then they get my money and I paid taxes for them?
Yeah, that's what I'm saying. We need to keep an eye on this. It doesn't make sense at the moment how that is going to play out in reality, because it doesn't make sense at all. But it's just I put it in there because I think it's worth noting, because it's worth just, hopefully not many people out there are going to lose their keys or have their funds stolen. So hopefully this won't be a problem to too many people. But I've just put it in there as a point to note that we need to keep an eye on this, because if, as and when this does happen, we need to make sure that we're doing our best to ensure that HMRC aren't taxing someone on funds they don't even hold. But also, remember that they could have disposed of certain funds, be holding it in Tether or something like that, and in one tax year, and then be stolen in the next tax year, and they would still class that as a taxable disposal on the person that had them in the previous tax year. That's what they're basically saying. So it doesn't seem fair, and like you say, I don't think there's practicalities that have been thought around this. I think they've just put a one-liner in there and just hope for the best.
They have to make money. They have to make money.
They've done a lot recently, haven't they? So
I have so many questions by followers, by people that are watching us right now. But let's move on with the presentation, guys. We will try our best to answer all the questions, but we still need to hear from Alex as well. So please, Joe, go ahead.
I'll rush through these quickly. So staking is taxed as miscellaneous income on your tax return, which basically means it's taxed under the kind of business income type rules. So the 20 or 40%, depending on where you're at. Airdrops is it's a fiddly one. Airdrops. So so HMRC for some reason have decided to determine the difference between an airdrop where you've done nothing and you've just been rewarded for holding a coin for a while or something like that, and an airdrop where you've actually had to go in and do some work and generate some reward, if you like, off the back of that. Now, I'm not 100% sure why they've decided to go really in depth on the airdrops, but they've not even thought about lost keys. But anyway, so at the moment they're saying that if you've done no work for the airdrop, then it's not a taxable event, but if you have, then it's taxed as miscellaneous income. Did you have quite a couple of facial expressions that suggested you might have a question?
No, it's just the
craziness. this.
Yeah, the craziness there.
Gifting is a taxable disposal, and it would be the same as selling it. And the purchase price, the individual that's received the gift, their purchase price will be the valuation of the asset on the day that it's gifted. The only exclusion to that is spousal transfers. So you can transfer to your spouse tax-free, and they have the same £12,300 limit as you. So a big tax tip, if you like, is use that. You know, if you've got a spouse and they've not got holdings, give them some if you're going to have a tax bill, because there's quite a lot of saving there you could have if you gave them enough to cover their £12,300. So this is where we briefly touch on margin trading and derivatives. So ultimately, the way HMRC have looked at this at the moment is that they have suggested that everything that is done on a margin or derivative basis is kept in kind of a separate pool to the rest of your assets, which I have been talking to Accounting about, and that is how Accounting is transacting, if you like, this sort of stuff. So that way it is taxed under CGT, again, or income tax, depending on where you're at. But it's a separate calculation to your day-to-day trading. Does that make sense? So you sell Bitcoin and Ethereum, etc. in a normal circumstance, you've got a capital gains tax over here, and then you decide that you want to do some margin trading on Bitcoin over here. It's classed as a separate pool, and the gain or loss on that is completely separate to the gain or loss on your standard trading tool over here. It's a little bit complicated, but hopefully that simplifies it enough to make sense.
Yeah. And I guess that's why we need an app like Accounting, right?
Yeah. And Alex, does that fit with you in terms of how you guys are?
Yep, absolutely. It's exactly how we're doing it.
Yeah, cool. DeFi and liquidity pooling, again, I'll go through this fairly quickly because it's, as you can imagine, it's pretty complex. What they're basically saying is, so the challenge of this, again, there's no direct guidance, and what they're saying is treat tools like Aave, for example, where you're earning passive income on loans, and liquidity pools and things like that, are basically, let's treat those the same as we treat staking, the way we treat mining, etc., and we put it all under miscellaneous income. There is no direct guidance on DeFi at the moment. And again, I think that's because HMRC just have absolutely no idea what it is and how on earth to deal with it. So at the moment, what I'm saying to people is treat it the same as staking and mining, the income that you earn from that, treat it as interest effectively, if you like. And as long as we're putting in a claim on a reasonable and just basis, then there's no reason why there'll be any difficulties for you down the line. The main problem we're coming across with DeFi is actually getting the transactions off those platforms and onto a platform like Accounting in the first place, because as you well know, guys, like signing up to a DeFi platform is pretty straightforward, and there's not a lot of KYC going on in the background there. And so actually identifying a lot of this stuff is very difficult. And I think the challenge HMRC are going to have is they're going to have to trust people in one sense, because I don't quite know, if you're trading on Coinbase, you're trading on Binance, they can leverage those companies to give them the information because of the centralized nature of the networks. But, with some of these DeFi platforms, I have no idea how they're ever going to check it. What I'm saying to people, I had a conversation.
Maybe in 5-10 years when they will develop the right tools, right, and they will get back to you and say, hey, where do you kept all this money for so long, right?
And the centralized, Coinbase has sent out letters, right, in the UK because HMRC have asked them to let everyone know that they will have to pay taxes.
And this is very important. And it's a question, Joe, because I originally come from Greece. So in Greece, the government, you don't expect actually to go back many years ago to see what you did with your taxes, if you filed your taxes. I'm not saying in crypto, but in general. But with HMRC, correct me if I'm wrong, they can go back as long as they want to if they find any discrepancies, right?
Yeah, depending on the circumstances, there are rules, and depending on the circumstances, they do have the power to go back quite a long time. But they'd have to find, in order to go back kind of 20 odd years, they'd have to find serious fraud. in order to go back that far. Realistically, the usual term is about 7 years, but they can, and we have had a client, not in the crypto space, that was doing a different bit of tax planning that at the time was fully legit, but when HMRC changed the rules, they were then allowed to go back. I'm not suggesting that they'll do this in the crypto space, but it is something to be aware of. And I had a conversation with somebody this morning, and I said, the best way, I think, for you to approach this is, you know the rules, you know that you should be taxed on this because it's income. So it's not like you don't know. Now, there are no guidance at the moment, so let's do the best we can. And if we ever get questioned, we've got a presentation we can provide that says, this is why we did it at the time, and these are the reasons, and there was no guidance, so we did our best. And they're not going to, there's nothing they can really do about that in that sort of circumstance. And bear in mind, probably 7 or 8 out of 10 people in this country right now are probably not going to declare a single penny of their crypto gains from
most likely.
Ultimately, these task forces are set up to get the easy wins. If you've got some documentation, some paperwork, and they don't even understand what they're looking at, they're never going to question you. So I think it's being sensible and approaching it in a sensible way in my opinion, is the best way to do it.
And I think it's a bit also in terms of like being a bit proactive is probably good, because the government is gonna, like, wherever they can make money, they're gonna come back, right?
Yeah.
And especially I read an article the other day that in a few years, half of the billionaires will be crypto billionaires, right? So definitely they will go after that, because we will see wealth concentrating to crypto. So that makes sense for governments to go after.
I'm really interested as well, like timely wise as well. Today, there's an article that's been released that HMRC have now updated their tax return forms for 2020, 2021, which is the first time it's included a box or a section around crypto assets. So every other year it's been, if you were carrying it, which not many people were, then it was just being classed as other assets, whereas it's now got its own specific, which it has in the US for a while actually, but it's got its own specific section now in the tax return. So they are starting to slowly get up to speed with it. So just quickly on NFTs, so conscious I've taken a really long time. Again, fairly new phenomenon in the world, and there are no guidance at the moment. So, like I said earlier, the way we're treating it is to say, let's just treat it as a physical asset. So, if you bought a physical painting for £100 and you sold it for £200, your gain is £100. Let's just treat the kind of the digital assets in exactly the same way, because again, if we ever get asked the question. And we all know we're not talking about £100 worth of gains in a lot of these cases. You don't want to be asked for a lot of back tax for something that cost and sold for a lot of money. So what we're saying is be sensible here, and have a sensible approach and have a backed up approach of what you've done. And ultimately, it will be very difficult for HMRC to challenge you on that basis, because there isn't any guidance at the moment.
It feels like this conversation shouldn't be 1 hour long, but like 2 or 3 hours, and answer questions forever.
It's not the most. It's quite a difficult subject to talk around as well. So that's the problem I find with it is there's so much to talk about, and it's also quite complicated. So yeah, but that's that's a fairly brief summary overview. I'm sure we've got a million questions. But yeah, over to you guys.
Maybe it's worth to have a second webinar. Actually, just to let the guys know, or whoever is watching, that we are going to have 2 more webinars with accounting. The next one will be for US taxes, because lots of our members are from the US, and we are going to have one. We haven't decided yet. The topic might be for German taxes and in general European. Tax in other countries in Europe. So with that being said, and before I pass the ball to Alex, just to let you know, in the description of this webinar, we have a giveaway from accounting, 3 pro plan accounts. You can see the secret code to unlock the giveaway, and you can take as many conditions as you want. This will give you more entries to the draw. So please, Alex, let us know what accounting can do for
Cool,
the poor people
absolutely.
that are trying to file their crypto taxes.
Absolutely, yeah. So actually, just to kick things off, I saw a question over from YouTube, which was, with accounting, can you use it on its own, or do you have to hire an accountant? So essentially, accounting, we built it so that we could do our own tracking and taxes. And I'm gonna share my screen in a sec. But essentially, the idea really is that all of us probably use some sort of a portfolio tracker, right? Most known as Delta and Blockfolio, I would say. And we kind of said, hey, look, we're putting all of these transactions in and all of this data into these portfolio trackers. It's kind of ridiculous that we have to do it again for a tax tool. And so that's why we decided for accounting to really focus on the two aspects of tracking and taxes. And so I'm just going to quickly share my screen. 1 second.
And I think one of the questions that it's good now that you will give us a demonstration of the platform or the slides you want to show us. It would be nice to understand how the user can be proactive, right? So let's say I have a MetaMask, I have a Binance account. How they can keep things clean? Probably one account for trading, one account for ICOs, one account for this, for the rest of the activities.
Exactly. So I actually wanted to go into exactly that. So obviously, Joe kind of talked about the aspect of DeFi and all of the transactions and smart contracts that you can use on Ethereum, and how data-wise that's obviously pretty difficult to pull all the transactions and correctly show all of the data. I think we have to go a step back actually and look at these centralized exchanges as well, right? In the end, the centralized exchanges are here to provide trading infrastructure. And so their main aim is obviously to get as many people to trade with them and ultimately to kind of have as many trading fees generated for them. And so a lot of them, specifically ones like Qcoin, for example, don't necessarily provide very good data quality. Meaning that if you're trading on these platforms, you're going to be missing a lot of data because they don't actually save them properly. And so if you really want to be very, very proactive, you really kind of go to creating a setup where you have Binance, where you have Coinbase, maybe Kraken, and Ethereum and a Bitcoin wallet, but really keeping things clean in terms of understanding that these different exchanges, the smaller they are, the more likely it is that they're not focused on good data, meaning that you're going to have to do a lot of manual work to fix things, whether it's inside of accounting or any of accounting's competitors. And so I don't know, are you guys showing my screen already, or?
Yeah, we can see your screen.
Cool. So essentially, the way accounting works is that you can add all sorts of wallets and exchanges, and most of these can be added automatically. And so Binance, for example, you can create an API key, and we pull all of the transactions from Binance. So there's one big aspect here in terms of security, of course, which is we make sure that we only accept read keys, meaning that we can't do anything with these keys, right? The only thing that we can do is we pull the transactions and kind of have that data, right? In terms of data security, we're really focused on that, and everything's fully encrypted. And we use a login provider Auth0 in order to make sure that the database between the login provider and the actual data provider is separate as well. So going back to this, as said, you can connect via the API key. You can also, of course, upload CSV files if you feel more comfortable rather than connecting directly. Or you can, of course, import things manually, meaning that you will put in the specific trade or the deposit or the withdrawal.
So Alex, quick question. How reliable is and I think Joe has a question as well, but how reliable is the API from exchanges? I remember when we talked about my trades on FTX a few weeks ago, and it seems that you might not get through the API all the trades, not the trades, but actually the labels, so you can calculate things efficiently. It seems that there are limitations there. So probably is it the CSV better?
So I would put it like this: if you kind of just wanna once do this, get your taxes sorted, and that's it, then the CSV is probably cleaner and easier. Although oftentimes also the CSV may not actually be fully accurate, where you're going to have to add things manually. But in terms of that, obviously, exchanges also change their API keys occasionally, meaning that they might, so Binance, for example, stopped providing the futures trades for a bit, and then they turned it on again via the API, or Binance currently does not provide the transactions where you're staking on Binance, so you have to add that manually. So there is a benefit to the aspect of the CSV, but there's also, of course, the benefit of the API where you can kind of refresh or every day kind of see your movements and your trades if you are trading on these exchanges that provide good data quality. Joe, did you have a question?
Yeah, just so one question that we get asked quite a lot, and I thought it would be useful for me to ask this now so that you can kind of answer this for all these people that are here is, and it's quite often with other firms as well, but an example of, so the API key you just talked about, and you only talk, as you say, you only want to accept read API key and whatnot, which is great. Obviously, people get, at the moment, you guys don't have a kind of accountant's portal. So in order for me to look at somebody's account, I need their password and username, etc., which some people are concerned about, especially with the amount of kind of crypto scams and things like that. Coinly also advised a potential client of ours against giving out their password because of the fact that the APIs were held in the system. Is there kind of like any kind of reassurance you can give, if you like, that even if I wanted to, there's very minimal I could actually do with these APIs because you're not taking an API that is able to do any transactional based stuff?
Yeah, so essentially, actually, once you have connected the API key, if a user, or for example, if you then log into the account on the wallets page, which I'll go to after, and you would click on Binance, you wouldn't actually be able to see the API keys. So essentially, this input is here, right? And once you click Save Connection, then it goes into our encrypted database, but you can't actually figure out what the secret key is afterwards. So if you log into the account, you can see that it's connected, but you don't know what the actual secret key is.
Yeah, great, thanks. I just wanted that clarified for people.
Yeah, absolutely.
Get that a lot.
Cool. And so, as said, for the exchanges, we have the API keys, the CSV or the manual, and for the wallets, we essentially connect directly to the blockchain. And so, I'm gonna take here a random Ethereum address, and if we look for Ethereum, where of course all of the ERC20s are living on as well, we click the save connection, and then it'll fetch all the transactions. And so we can click on OK, and now it's essentially importing.
Pretty simple. And I have to admit, your synchronization and the calculations is pretty fast.
Yeah, so exactly.
It's something
and so then essentially what it is this is kind of the overview portal. You can see your holdings, you can see your net profits, you can change your year over the time period of the chart. You can also click specifically into the chart. Obviously, this guy has done a good bet on Ethereum here. You can also see some nifty.
Who hasn't?
That's very true. You can also see some nifty things here, like how you're performing in comparison to other users. Again, obviously, none of the data is shared or anything. And you can also see your portfolio allocation over here, and the wallets that you have. And so when we get into the tax part, obviously this is more of the tax discussion. Anyone's open to trying out accounting. It's completely free. You only pay for the tax package. And so in the full data set, this is essentially where you see all of your transactions. So this is all the transactions that have ever happened on this Ethereum address. And this is where you can also classify the transactions, right? And this is what Joe was speaking about. Obviously, different sort of transactions have different effects on your taxes. And so this is where you can classify those. So maybe this deposit, maybe someone paid me for something, and so I could classify this as income, and then it's classified, and inside of the tax report, it would then be shown as income as well. In terms of the aspect of, sadly, the crypto data infrastructure really isn't just yet the best, right? Because as said, exchanges don't necessarily want to focus on it. They want to focus more on giving a better trade engine, for example, or anything like that. And in this case, we've created this review flow, which essentially is 4 steps where accounting tells you where your data might be wrong. And so you might have a situation where we don't pull the prices of a certain coin that you have. We pull all our prices from CoinMarketCap currently. We're going to be adding new providers as well, such as CoinGecko, to have more coins. But sometimes you just have such a small coin that it's not even listed there. And so here you can then assign that coin. In the identifying internals, this is a very important part. This is obviously the aspect of if you buy, say, 1 Bitcoin on Coinbase and then you send this Bitcoin to your wallet, you don't want to lose the length at which you've been holding this coin, right? Because otherwise your taxing of it may become different. And so what we do is we follow or make sure that every coin that you have holds the holding period, which we call it, so that the taxation of it stays. And so this is where an internal transaction is any transaction that's happening within your crypto ecosystem. Then step 3 is just a classification. Again, all of your transactions here will be that have open ends. So obviously a trade just gets capital gains tax on it, but possibly you have income in crypto or anything like this, and you can classify that here. And then what you do is you'll go to the tax report, and in the tax report, it'll tell you what your gains are. Obviously, I only have 1 wallet integrated here, and then you can print your report. And so all of it here is free. The only thing that you then essentially pay for is the creation.
Just sorry for interrupting, Alex. Just for clarification, because on the screen share we see euros, it will be in pounds, right?
Yes, exactly. This is sorry. Yeah, exactly. So we right now have specific reports for Germany, Switzerland, the US, Austria, UK, and we have an other countries report, which works for most other European countries. This is just the UK report we've obviously done with UK tax accountants to make sure that the gain and everything is, and the method and everything is correct.
Just a quick note on that, though. What I do say to people as well, though, it is, I know there was a question about do you need an accountant and stuff, and I know Alex answered it, but from my perspective, yes, this has been done to the best of the ability of the team, and we worked them on it, and lots of, but things do change. So I always think that it's good to get even this report signed off, or at least checked by an accountant, just to make sure things have been classified correctly and that the rules haven't changed, and just to make, because what we don't want is you paying more tax than you need to. So always best to get it checked, I would say. Exactly.
I also think that, I mean, obviously, the accountants, I mean, if you're getting, essentially accounting is here to make sure that you have everything prepared, and sure, if you have accounting knowledge, then you can maybe figure these things out yourself. But absolutely, if you want to double check, it makes 100% sense to kind of spend time on making sure your data set is correct and then show it to an accountant just in case, right? And especially, I mean, with crypto gains, I feel like you're making enough money to be able to pay an accountant as well.
Yeah. Cool.
And probably an accountant can help you, right? Like if you can classify this as a different way, that might help you pay a little bit less.
Exactly.
That would actually pay off.
When we've looked at a few accounting accounts, you know, and others, you know, Coinly and whatnot as well, it's, people have classified things in a certain way because they haven't necessarily realized the implications of doing that. Do you see what I mean? They're just thinking, oh, I'll classify that as income or whatever it may be, when actually it wasn't. And actually we can then, it's not so much us saying we want you to pay more tax. We actually want to make sure you're not paying too much. So I completely agree. It's just that extra bit of sign off really to make sure that that it's correct.
Yeah.
Right. So unless you finished, Alex, maybe we can go through a few questions. We have very few minutes. I don't know. Is there anything else you would like to add for accounting?
No, I think try it out. And as said, I think the more proactive you are, and as said, like it all depends on how much kind of you want to hustle in crypto, right? If you want to go for the really small shitcoin, so to speak, then yeah, you have to go on smaller exchanges or something. That's just going to mean that you're going to have to deal with more manual work on the accounting and tax side, right? If you want to keep things simple, stay to kind of the big exchanges, you know, Ethereum or Bitcoin. That'll make your life a lot easier as well. Yeah,
and we
actually,
display right now.
Could you go through the plans actually? What's the difference between the plans on?
Sure, absolutely.
Yeah,
so
that would be useful. And we have the secret code right here. We are drawing. We have 3 pro subscription plans for accounting. So click on the link in the description and add the secret code to unlock the giveaway.
Prize. Yeah. What do you get on that pro plan?
Let's see.
And I guess it's something you could use every day, right? I mean, because I don't remember what I did yesterday. So
yeah, exactly.
Back, you know, 6 months. And then what is this 0.025 Ethereum transaction? I don't know what I did.
Yeah, exactly. I think that's kind of the reason why we're really trying to, and that's why the API keys is helpful, because that just pulls everything in, right? And you can kind of just make sure that every day you wake up, you know exactly what the status of your portfolio is, right? And yeah, you will have some manual work most likely, but it's going to help in terms of kind of just doing it on one platform rather than doing it on a tracking platform and a tax tool, right? That just gives it more work, which is kind of unnecessary.
If I may jump in quickly as well, so a couple of things. You know, the one thing I like about it, forget the tax side of it, the personal side of it, is it as you know, I can log in and I actually use it most of the time to see where my portfolio is at, because I've got assets across multiple exchanges. So the easiest way for me to look at where I'm at is on that, and they've got an app as well, not just a web browser. So I think that is important. I think you've got. Were you going to show the plans?
Yes. So essentially, let me quickly share my screen. One sec. So exactly. So the way that our plans essentially work is they're based on transaction amounts. So based on total transactions. So it's not yearly transactions. And so these are the transactions for, or the packages, sorry, for the UK. So up to 25 transactions, you actually get a free tax report. Up to 500 transactions, you pay £79. And further on, you go bigger. We have a limit of 50,000 transactions. That's just because that's a lot of calculation power that needs to be done on our end. We are working on scaling that up, but that currently is the limit. Just to kind of get an understanding, obviously, the situation in terms of why total transactions, this is the situation that you might have purchased something 2 years ago and it might affect something that you do today, right, in terms of your taxes. And so that's why we've done it like this, because Accointing has to do the calculation for all of the transactions that you have.
Got it. Fantastic. I
just quickly,
sorry, Joe.
I think this is really important. I'm sorry to jump in on your product, Alex.
Don't worry.
No, absolutely.
I think the really important thing as well, which a lot of people don't realize, is a Coinly, for example, will charge you per tax year, whereas you guys offer a 365 days year license. So it doesn't matter how many tax years you run in that license period. I think that's important as well, Alex.
Yeah, exactly. So the aspect of, obviously, if you haven't done your taxes for 2018 or 2019, then I guess, Joe, you can help with that as well, right? You can backfile essentially, right? And so with Accointing, it's a 365-day license, and you can print as many reports for whichever years that you like. And can you speak towards kind of refiling and everything? Maybe that is interesting to some people, Joe.
Yeah, I mean, I don't think there's going to be many people out there that are going to want to go back to the dark times and stuff. But we have had a few conversations with people about that, and I just think it's important to note, especially as we're now in a different tax year to what we were obviously just a month ago in the UK. So you already would have moved into a new tax year in certain circumstances. So I just thought that was important. The other thing we can do, obviously for a fee, but we are able to help with it, is we can offer, in line with the guys at Accointing, a kind of a review and an overview of your Accointing account, and we can tidy it up on your behalf. Obviously, there's a fee for that, but if you're kind of looking at your Accointing kind of ledger and thinking, I don't even know where to start or whatever, you can kind of outsource all of that, to us if you need to.
Cool. Guys, we run out of time. Unfortunately, we didn't have the time to answer a lot of questions, but that's something we need to think about. Maybe we can have another session, an AMA of some sort. I think it's a very critical pain point for everyone when it comes to taxes. Usually people, they just look after the trades where they the entries, and at the end of the year, they have to file their taxes. Thank you so much for your time. Just to say that we have a giveaway. We displayed the secret code to unlock it. And also for whoever is interested, join us on the Birb Nest Discord community. Accounting will be our partner, dedicated partner. So we are going to have special offers and a discount that you cannot find anywhere else. That was a very good session, in my opinion. So thank you so much, Joe. Thank you so much, Alex, and Dave as well. And we will keep in touch, guys.
Thanks for having us.
Thanks a lot, guys.
Take care.
Have a good one.
Bye-bye.
Bye.